President Donald Trump did strike a deal, reaching a new trade agreement with Chinese leaders overnight.
Chris Souttig's in the newsroom this morning, and there is hope that this could ease months of trade tensions as the president heads back to Washington.
Yes, Mark. Big developments this morning from President Trump's visit overseas. He's returning to Washington and announcing a new deal with China to lower tariffs against that country.
We have a deal. Now, every year we'll renegotiate the deal, but I think the deal will go on for a long time, long beyond the year.
Trump's approach toward geopolitics has always been unpredictable, and for American soybean farmers, that unpredictability could once again put billions of dollars on the line. On paper, the new China-U.S. soybean deal looks like relief. After months of stalled exports and collapsing demand, China has returned to the U.S. market with commitments to buy millions of tons of American soybeans. Prices stabilized, futures reacted, headlines turned optimistic. But across farm country, optimism is not the dominant emotion. Caution is, because farmers have seen this movie before, and they remember how fast it ended last time. Just a few years ago, soybeans became ground zero in a geopolitical standoff between Washington and Beijing. Tariffs were announced, retaliation followed, and almost overnight, China, the single largest buyer of U.S. soybeans, stopped buying. Not gradually, not partially. In some months, purchases dropped to zero. For American farmers, the impact was immediate and brutal. Soybeans piled up in storage. Prices fell below profitable levels. Cash flow dried up while operating costs, fertilizer, seed, equipment, fuel, kept climbing. Many farmers survived only because of emergency federal aid payments designed to offset losses caused by trade policy. That experience left scars. So when today's deal is announced, farmers don't ask, how much will China buy? They ask a different question. How long before this falls apart? The concern isn't hypothetical. It's structural. China's demand for soybeans hasn't disappeared, but China has changed how it sources them. During the trade breakdown, Beijing aggressively shifted purchases to South America, especially Brazil. Infrastructure was expanded. Supply chains were rerouted. Relationships were strengthened. That means the U.S. is no longer China's only reliable option, and that reality weakens America's leverage. At the same time, Trump's negotiating style remains aggressive and transactional. Tariffs are not just economic tools in his playbook. They are political leverage. That strategy can produce short-term wins, but it also introduces instability. Markets hate instability. Farmers feel it first. All it takes is one escalation, one tariff announcement, one breakdown in talks, one geopolitical flashpoint unrelated to agriculture, and soybeans are back in the crossfire. That's why many farmers view this deal not as a resolution, but as a pause, a temporary reopening of a door that could slam shut again without warning. Even the structure of the agreement adds to the anxiety. Much of China's recent soybean buying has been driven by state-owned enterprises and government reserves, not purely by private market demand. That distinction matters. State buying can stop as quickly as it starts, especially if political priorities change. There is also the issue of scale. While the volumes being discussed sound large, they still fall short of the peak years when China routinely absorbed the bulk of U.S. soybean exports. Farmers know this means the margin for error is thin. If exports stumble again, there is no guarantee prices will hold. And unlike traders, farmers can't exit the market overnight. They plant months in advance. They borrow against future harvests. They make decisions today based on expectations that may collapse tomorrow. That's the fear hanging over rural America right now. Not whether the deal exists, but whether it lasts. And as long as U.S.-China trade remains tied to volatile geopolitics, soybean farmers understand a hard truth. Their livelihoods are no longer determined only by weather and yields, but by decisions made thousands of miles away, in rooms they will never enter. To understand why the China-U.S. soybean deal carries so much weight, you have to understand one thing first. Soybeans are not just another crop. They are the backbone of America's agricultural export economy. And for years, they have been the single most important agricultural link between the United States and China. Before trade tensions escalated, soybeans consistently ranked as the top U.S. farm export to China by value, generating tens of billions of dollars annually. In peak years, China purchased more U.S. soybeans than all other countries combined, accounting for roughly 50 to 60% of total U.S. soybean exports. No other crop comes close to that level of dependence on a single foreign buyer. Corn, wheat, and other grains are spread across multiple markets. Soybeans are different. The math is simple and unforgiving. When China buys, prices rise. When China walks away, prices collapse. That's because soybeans sit at the center of multiple global supply chains. They are crushed into meal to feed livestock, especially pigs and poultry, and processed into oil used in cooking, industrial products, and biofuels. As China's middle class expanded and meat consumption surged, its demand for soybeans exploded. Domestic production couldn't keep up, so imports became essential. And the United States, with its scale, infrastructure, and reliability, became China's preferred supplier. For American farmers, that relationship shaped planting decisions for decades. Millions of acres across the Midwest shifted toward soybeans precisely because the China market existed. Equipment investments, storage facilities, transportation networks, and rural employment all grew around the assumption that Chinese demand would remain strong and predictable. But that predictability no longer exists. When trade tensions disrupted soybean exports, the ripple effects went far beyond farm fields. Grain elevators backed up, rail and barge traffic slowed. Local economies that depend on agriculture felt the strain almost immediately. This is why soybeans are often described as the canary in the coal mine of U.S.-China trade relations. When diplomacy breaks down, soybeans are usually the first casualty, and that vulnerability is amplified by global competition. During periods when U.S. soybeans face tariffs or political friction, China doesn't stop consuming soybeans. It simply buys them elsewhere. Brazil, in particular, has emerged as a powerful alternative supplier, investing heavily in production capacity, ports, and export logistics. That shift matters because once supply chains move, they don't always come back. From a purely economic standpoint, soybeans are one of the few commodities where U.S. farmers cannot easily redirect surplus supply to another market of equal size. Europe, Southeast Asia, and domestic buyers simply cannot absorb the volume that China can. So, when China reduces purchases, the excess doesn't disappear. It pushes prices down across the entire market. This is why soybean prices are more sensitive to geopolitics than almost any other agricultural commodity. And it's why every announcement, rumor, or policy shift related to U.S.-China relations sends shockwaves through soybean futures markets. For policymakers, soybeans are leverage. For traders, soybeans are volatility. For farmers, soybeans are survival. That is the context in which this new deal must be understood. Because when the largest buyer of the most geopolitically sensitive U.S. crop is involved, no agreement is just about trade volumes. It's about whether the foundation of America's agricultural economy remains stable or starts to crack again. To understand why today's soybean deal feels fragile, farmers and traders look backward, not forward. Because the current agreement exists only after the market was first pushed to the edge. Donald Trump's trade strategy has always relied on pressure. Tariffs, in his view, are leverage, a way to force concessions from trading partners by making economic pain unavoidable. In theory, the strategy is simple. Apply tariffs, endure short-term disruption, extract a better deal later. But in agriculture, short-term disruption carries long-term consequences. When the United States imposed tariffs on Chinese goods, Beijing responded not symbolically, but strategically. Instead of targeting random imports, China focused on politically sensitive sectors, and soybeans sat at the top of that list. The logic was clear. Soybeans are grown overwhelmingly in rural America. They are exported in massive volumes, and they are deeply tied to voter blocs that matter in U.S. elections. By targeting soybeans, China could apply pressure where it would be felt fastest and loudest. The result was swift. Chinese buyers canceled U.S. soybean orders. New purchases slowed to a crawl. In some months, they stopped altogether. The world's largest soybean importer effectively stepped away from the U.S. market. Prices reacted immediately. Soybean futures fell as traders priced in lost demand. Cash prices at grain elevators dropped below levels many farmers needed just to break even. Storage facilities filled up as crops that would normally be shipped overseas sat idle. At the same time, production costs didn't pause. Farmers still had to pay for fertilizer, seeds, land rents, fuel, labor, and loan interest. Unlike manufacturers, they couldn't simply shut down production in response to market signals. Crops already planted still had to be harvested. That imbalance created a crisis. To offset the damage, the federal government rolled out emergency aid programs designed to compensate farmers for losses linked directly to trade policy. Billions of dollars were distributed across farm country, effectively replacing export revenue with taxpayer-funded support. For many producers, those payments weren't a bonus. They were a lifeline. But the aid also underscored a hard truth. The market had been broken badly enough that it could no longer support itself. Meanwhile, China didn't stop buying soybeans. It simply stopped buying them from the United States. Brazilian exports surged. South American supply chains expanded. Ports were upgraded. Long-term contracts were signed. What started as a temporary adjustment began to look permanent. This is where Trump's strategy produced unintended consequences. While tariffs created negotiating leverage, they also accelerated China's efforts to diversify away from U.S. agricultural dependence. Once those alternatives proved viable, America's position weakened. By the time negotiations restarted, the landscape had changed. China no longer needed U.S. soybeans the way it once did. It wanted flexibility, the ability to buy American soybeans when prices were attractive or politically convenient, but not to rely on them exclusively. That shift explains why today's deal looks different from past trade relationships. It's not a return to the old system. It's a conditional arrangement. From a negotiating standpoint, Trump could argue the strategy worked. Pressure was applied, talks resumed, and China came back to the table. But from the farmer's perspective, the cost of that pressure was absorbed long before any agreement was reached. The market damage didn't occur at the end of negotiations. It happened at the beginning. And even now, the memory of that collapse shapes behavior. Farmers are cautious about expanding soybean acreage. Lenders are more conservative. Traders treat Chinese buying as temporary, not guaranteed. Everyone involved understands that the same policy tools used to secure the deal could also dismantle it. That's the paradox at the heart of Trump's trade strategy. The very tactics that helped force negotiations are the same ones that make markets nervous about trusting the outcome. And for soybeans, a crop that depends more than any other on stable export relationships, that nervousness translates directly into volatility, hesitation, and risk. Which brings us to the next question farmers are asking. If the market broke once under tariffs, what stops it from breaking again? After months of stalled exports and market anxiety, the question wasn't whether U.S. soybean farmers needed a deal. It was whether China still needed the United States. That reality framed the negotiations that eventually led to the renewed soybean agreement. By late 2025, pressure was building on both sides. For the United States, farm state unrest was growing louder. Soybeans had become a political liability, not just an economic one. Rural communities were feeling the aftershocks of lost exports, and federal aid payments, while substantial, were not a sustainable replacement for real market demand. For China, the situation was more nuanced. Beijing had successfully diversified a large portion of its soybean imports toward South America, particularly Brazil. But relying too heavily on a single region carries risks of its own. Weather disruptions, logistical bottlenecks, and price volatility. Maintaining access to U.S. soybeans still mattered, even if China no longer wanted dependence. This is where Trump's negotiating approach re-entered the picture. Rather than dismantling tariffs outright, the administration framed soybean purchases as part of a broader trade truce, not a permanent resolution. The message was transactional: access in exchange for volume, stability in exchange for restraint. The talks culminated in a high-level meeting between President Donald Trump and President Xi Jinping, where soybeans were placed back on the table, not as a symbolic gesture, but as a measurable commitment. The result was a structured purchasing agreement. China agreed to resume buying U.S. soybeans, starting with an initial commitment of approximately 12 million metric tons in the near term, followed by annual purchases of at least 25 million metric tons over the next several years. From a political standpoint, the deal allowed Trump to claim a concrete win. China was buying American farm goods again. From an economic standpoint, it reopened an export channel that had been nearly frozen. But the way the deal was executed reveals its limitations. Much of the initial buying was carried out by state-owned Chinese enterprises, not private market players. That distinction is critical. State purchases can be driven by diplomatic considerations rather than pure market demand, and they can be paused or redirected just as quickly. In other words, the agreement restored access, but not certainty. Trump's role in securing the deal was consistent with his broader style: maximum pressure followed by selective de-escalation. Tariffs remained largely intact, preserving leverage, while agricultural purchases were used as a pressure release valve to stabilize domestic fallout. Supporters argue this approach forced China back into the U.S. market. Critics argue it created a cycle of disruption and repair that left farmers exposed in the middle. What's clear is that the deal did not represent a return to the pre-trade war status quo. There were no binding enforcement mechanisms guaranteeing long-term continuity, no commitments shielding agriculture from future tariff escalation, and no assurance that private Chinese buyers would fully re-embrace U.S. soybeans once state-directed purchases tapered off. In effect, Trump managed to reopen the door, but he didn't rebuild the house. For farmers, that distinction matters. The deal provides volume, but not insulation. It offers relief, but not immunity. And it exists entirely within a geopolitical framework that can shift without warning. That's why markets reacted positively, but cautiously. And it's why the next question became unavoidable. Now that the deal exists, what does it actually change on the ground? That brings us to the numbers. When the China-U.S. soybean deal was announced, the numbers sounded impressive. Millions of tons, multi-year commitments, a clear signal that trade was back on track. But for farmers and market analysts, the real story isn't in the press releases. It's in the details. At the center of the agreement is a short-term commitment. China agreed to purchase around 12 million metric tons of U.S. soybeans in the initial phase of the deal. That buying was designed to restart trade flows quickly, stabilize prices, and send a message to markets that the standoff was easing. On top of that, the agreement outlined annual purchases of at least 25 million metric tons in the following years. On the surface, that looks like a return return to normal, but historically it isn't. Before trade tensions reshaped the market, China regularly imported 27 to 29 million metric tons of U.S. soybeans per year, and in some years, even more. Those volumes weren't framed as political commitments. They were driven by pure demand. In other words, the New Deal restores part of what was lost, not all of it. That gap matters because soybean markets don't need demand to collapse to feel pain. They only need it to fall short of expectations. A difference of a few million tons can mean the difference between profitable prices and break-even farming. There's also the issue of timing. Much of the initial buying under the deal occurred during a narrow window, driven by government-directed purchases rather than organic market demand. State-owned Chinese firms stepped in to meet the commitment, filling reserves and signaling compliance. That's not the same as long-term commercial confidence. Private crushers and feed producers, the buyers who sustain steady demand year after year, have remained more cautious. They continue to balance U.S. supplies against Brazilian and South American alternatives, often choosing based on price, logistics, and political risk. This means U.S. soybeans are competing again, not reclaiming dominance. Another critical omission in the deal is enforcement. There are no hard penalties if China slows or redirects purchases beyond broad diplomatic consequences. And there are no safeguards protecting soybeans from becoming leveraged again if trade tensions flare up in unrelated sectors, technology, defense, or currency policy. That uncertainty keeps markets on edge. Traders understand that the deal is not legally binding in the way a commercial contract is. It's political. And political agreements operate on trust, alignment, and ongoing incentives, all of which can shift rapidly. For farmers, the takeaway is uncomfortable but clear. The deal improves the present, but it doesn't secure the future. It provides a floor, not a ceiling. It stabilizes demand, but doesn't eliminate risk. And it depends heavily on geopolitical restraint rather than market fundamentals, which is why, despite the positive headlines, planting decisions haven't surged and optimism remains guarded. The deal exists, but it exists conditionally. And that distinction becomes even more important when you look at how markets responded and how fragile that response really is. That brings us to the next question everyone is watching. What did this deal actually do to soybean prices, and how long can that effect last? When news of renewed Chinese soybean purchases hit the market, the reaction was immediate. Soybean futures moved higher. Prices that had been drifting under pressure finally found support. For the first time in months, traders had a clear signal that the world's largest buyer was back, at least for now. From a market psychology standpoint, the response made sense. China doesn't just buy soybeans, it sets the tone for global demand. Even the possibility of renewed purchases is often enough to lift prices, because it removes the worst-case scenario from the table, total demand collapse. But the rally was measured, not explosive, and that tells its own story. While prices rose, they did not return to the highs seen before. Trade tensions escalated. Futures reflected relief, not confidence. Traders treated the deal as a short-term stabilizer rather than a long-term bull signal. There are several reasons for that caution. First, global supply remains abundant. Brazil and Argentina continue to produce large soybean crops, and South American exports remain highly competitive. Even with China buying from the United States again, it is not buying exclusively from the U.S. The global market is well supplied, which limits how far prices can rise. Second, much of the initial Chinese buying was already anticipated. Markets had partially priced in the possibility of a deal before it was formally announced. Once the numbers were confirmed, there was no surprise surge, only confirmation of expectations. Third, traders are acutely aware of political risk. Soybean prices are now tied not just to weather, yields, and inventory levels, but to policy decisions. Any signal of renewed tariff escalation, diplomatic friction, or trade breakdown can reverse gains quickly. That volatility keeps speculative money cautious. From the farmer's perspective, the price movement offered breathing room, but not security. Cash prices improved modestly at local elevators, easing some pressure on inventories. But for many producers, prices remained close to break-even levels once production costs were factored in, and costs have not come down. Fertilizer, seed technology, equipment financing, and land rents remain elevated. That means higher prices are needed just to maintain profitability, not to expand operations or invest for the future. In effect, the deal stopped the bleeding. It did not restore health. Another key issue is timing. Much of the price response occurred before farmers could fully benefit from it. Many had already sold portions of their crop earlier at lower prices, simply to manage cash flow and storage constraints. Late-season rallies help, but they don't erase earlier losses. This creates a disconnect between market headlines and farm reality. Prices may look stronger on charts, but balance sheets remain tight, and there's a deeper concern concern beneath all of this: sustainability. Markets understand that the current price support depends heavily on continued Chinese participation. If that participation slows, or if political conditions change, the same forces that pushed prices down before could reappear quickly. That's why analysts describe the current market as supported but fragile. Supported by diplomacy, fragile because diplomacy can fail. For now, soybean prices are holding, not because the market is strong, but because the worst-case scenario has been postponed. And postponement is not the same as resolution, which leads directly to the next question farmers are asking. If prices are only temporarily supported, what does this actually mean for farmers trying to survive and plan ahead? For American soybean farmers, the return of China to the market has brought relief, but not reassurance. The difference matters. In the short term, the deal provides something farmers desperately needed: an outlet. After months of watching soybeans pile up with fewer buyers willing to absorb volume, renewed exports offer a way to move inventory and stabilize cash flow. That alone makes the agreement meaningful. But relief doesn't erase the damage already done, and it doesn't guarantee protection going forward. Many farmers entered this season carrying losses from previous years of trade disruption. They borrowed to plant, borrowed to harvest, and borrowed to store crops they couldn't sell at a profit. Interest expenses climbed alongside input costs, tightening margins even further. For those producers, the deal arrives late, not as a reset, but as a partial recovery. There is also the issue of planning. Farming is a long-cycle business. Decisions about acreage, crop rotation, and investment are made months, sometimes years, in advance. When export markets become unpredictable, those decisions turn into calculated risks rather than strategic choices. The soybean deal does not eliminate that uncertainty, because farmers understand that China's buying is conditional. It depends on geopolitics, not just demand. That makes soybeans a more volatile bet than they used to be. As a result, some producers are reconsidering acreage allocations, shifting marginal land back to corn or alternative crops where possible. Others are planting soybeans but hedging more aggressively, locking in prices earlier even if it limits upside. Neither approach signals confidence. Another challenge is cost pressure. Even with modestly higher soybean prices, many farmers are operating in an environment of elevated input expenses. Fertilizer costs remain volatile. Seed technology fees are high. Equipment costs and financing have risen sharply. That means higher revenues don't automatically translate into higher profits. For smaller and mid-sized farms, the margin for error is especially thin. A single bad season, caused by weather, price swings, or policy shifts, can push operations into serious financial trouble. This is why the deal, while helpful, hasn't sparked celebration across farm country. Instead, it has reinforced a sense of vulnerability. Farmers know that they have little control over the forces shaping their markets. They don't negotiate trade deals, they don't set tariffs, and they don't influence diplomatic strategy. Yet they absorb the consequences when those strategies change. In that sense, soybeans have become more than a crop. They've become a political instrument. And that reality weighs heavily on producers who simply want stable markets, predictable demand, and the ability to plan for the future. For now, farmers are watching closely, watching policy statements, watching futures markets, watching China's buying behavior, because they've learned that optimism without caution is dangerous. And while this deal may hold for now, no one in farm country is assuming it will. Which brings us to the bigger picture, because what happens to soybeans doesn't stay on the farm. It ripples through the entire U.S. economy.